and the user impact. So as we were, basically we started the chapter discussing risk. And we started by talking about what risk is. And there are 4 kinds of risk in auditing. We started by talking about the business risk. And what is the business risk? Aaron, do you remember what we said business risk is? It's okay. Does anyone else want to contribute, Todd?
It's risk that affects the operations and potential outcomes of organizational activities.
Risk that affects the outcomes of organizational activities. And we know that the external environment can create those issues as it relates to risk. The current environment, the market environment, the economy. If we were right now dealing with a bank that invests heavily in student loans, would we probably have a concern about that right now? Carmen, why would we have a concern with a company that primarily focuses on student loans?
Because the majority of their business is in high debt.
The majority of their business is in high debt and is very volatile, and the consensus is that might be our next meltdown. Like the home business industry really caused almost an economic disaster in the U.S. They're thinking the education, student loans, I think is far greater. And guys, one difference is with educational or the student loans, is there collateral? There's no collateral out there. It's kind of scary, isn't it?
Plus the credit requirements are very, very lax.
Credit requirements are very lax. You know, what do you do? How do you get people to pay back those student loans? I mean, granted, right now, unless there's like reason of mental illness or things, nobody forgives a student loan. They'll withhold your federal income tax return for it. But at what point, if someone's self-employed, does that even help? So business risk are those factors, those external factors that ultimately play into account the organizational's activities, as Todd so succinctly stated. What's another type of risk? Financial reporting. And those are the risks that the financial statements are presented clearly, aren't they? And you worry about that because you've got to trust that the company really is recording the transactions as they should be recorded. 2 more risks. What was another one? The engagement risk. Who can discuss what the engagement risk was? The engagement risk that could affect the auditor because they're associating with a specific type of company. I made reference to, let's say there is a new technology industry out supporting something that can be controversial. It could affect me as a business if in fact the public is very anti on a certain product or client basis, or how it plays out within society. Can anyone think of an example of where an engagement risk could pose a problem? Anyone? Hey guys, is Sensors still operating the bars? Are they all open, or did they all? They are all open? I just wonder if what happened with Amy Sensor, how that could have affected their business. Not that that's what engagement risk is, but let's just say people are so upset about that the man who was killed, and the outrage of even supporting the censor empire. Would you even want to be an auditor involved in people upset with you because you're in fact working with them still? I'm not saying right, wrong, good, or bad, but it's just things you want to be aware of. And then lastly, what was the final risk that auditors need to be concerned about? Audit risk, ARB. And what is audit risk?
The risk that the auditor may provide unqualified opinion on financial statements that are materially misstated.
The risk that an auditor will create, go through the work and provide an opinion on the financial statements that is in fact incorrect. Boy, that's what we worry about. That's the whole reason we go through this whole process, is that we have the procedures, that systematic approach in place, that we are going to plan the audit and perform the audit to fairly much be assured that the financial statements are going to be free from material misstatement. And in doing that, we really need to take account into all the various aspects we talked about, getting understanding of the client, really being in touch with how the management climate is, looking into the internal controls, so we really can assess which accounts can be at risk. So that's in a nutshell where we ended yesterday. Does anyone else have something to say? What chapter? I got the wrong chapter up, don't I? Anything else you guys have to say for that? Yes, no? Okay. So this chapter really focuses on the various risks at place as it relates to the audit. And this was a really helpful slide to see, where we talk about the 4 different risks and how the economic climate, any technological changes, competition, volatility, locations, geographically speaking, can affect business risk, and how those internal potential issues like integrity of management, incentives management might have to misstate financial statements, complexity of transactions, internal controls, ultimately affect the financial reporting risk. Combined, they both go to play a part in engagement risk and finally within the audit risk. Something really important to look at. Then we talked about how management, or if an auditor is changed, the auditor that is potentially considering taking on the engagement has a duty to communicate with the previous auditor to see why they left the engagement, any issues, potential problems. Because if there is a previous auditor that is no longer there, don't you want to know why? Wouldn't that have a say if in fact you want to take on this client? So we talked about issues that could be things to look at for high-risk clients. When there's a low entry cost into the market, why can that be a potential problem? Anyone can get in, so your competition could be fierce, couldn't you? And of course, instability of future cash flows, that affects the ability to operate, as a going concern if you can't pay your bills. So definitely items, look at the lecture from yesterday, definitely items to look at. Then we talked about the engagement letter. What is another term for the engagement letter? Michael, do you remember? You weren't here yesterday, Michael. That's not fair to ask you. Anyone want to talk? Ed, what is an engagement letter? What's another term for an engagement letter? We learned it in business law. Contract. The engagement letter is basically a contract between the client and the auditor, and it really spells out all the details and expectations of those two parties. It's required to have an engagement letter, okay? Then Sarah started us, and now we're back. We're going to start talking about materiality. Materiality can be subjective, can't it? Materiality, our example we posted yesterday is, let's talk about a bank account. If we're dealing about Nancy Shoemake's bank account, and I might have a range of, if I'm off 40 or 50 bucks from my balance, it might not be material for me. But if I'm off $3,000, do you think that's material when my normal balance is $1,000? Is that a concern? Material. Now let's switch to Delta Airlines. Do you think 40, 50 bucks, that wouldn't be material? Do you think $4,000 or $5,000 would be material? Do you think it would?
Yeah, it's a big enough mistake.
A big enough mistake? I would think more like 40,000 might be material for Northwest or Delta, just because of the volume of transactions that are flowing through. I'm not saying they don't care about it, but something for them to really focus on. Materiality is related to the particular circumstances. So basically, based on circumstances, would that type of omission or change affect the user who's using it? So for example, with Delta Airlines, if there's an error of 4,000, is that in the scope of making billions of dollars really going to change their opinion of investing in a company or not? No. But if I'm a little startup company making 100,000 a year, and for me being off 4,000 in an account, that's probably going to be material for me trying to get like a Todd and Michael to come in and invest in my company. When I'm only making 100 and I'm off in my bank account 4,000, do you think that could be enough of an error that they would decide maybe I shouldn't be investing with this chick? So maybe it would be an error for material for me, but not Delta Airlines. Why? Look at the numbers. We're talking 100,000 versus 5 billion. Do you see what I'm saying? You got to look at the whole scope of this to understand materiality. The lower the dollar amount of set materiality, the more rigorous the examination. What that mainly means is if it's material for me to be off $1,000 versus $4,000, in other words, with an audit, it becomes a material issue if I'm off 1,000. That means the audit needs to be much more involved and detailed because they have to do more testing and checking than if materiality would play out in a $4,000 area. Am I making sense what I'm trying to say there? So if I'm looking, if I'm narrowing my search on materiality, as a result, the audit is going to have to be more extensive. Planning materiality for the statements as a whole is ultimately how the auditor initially goes in and looks at the financial statements. But then they take that risk of materiality as a whole, and they'll link it and separate it into specific types of accounts and focus on those more risky accounts. So there is something called the audit risk model. So the audit risk model is basically audit risk here is inversely related to engagement risk. Now, what the heck does that mean? Audit risk is inversely related to engagement risk. If the auditor accepts a client with high engagement risk, the auditor needs to conduct a more rigorous audit. The audit does this by setting audit risk at a low level. So think about this. If, let's say, we're going to audit Blockbuster. Blockbuster wasn't doing well, but boy, they were trying to do one last hit with the market to try to create, a wave of interest. And, we're worried about them being a going concern, and our engagement risk, we don't know if this is really a good idea to take on this particular client. And so our engagement risk is high. It's a high risk that this might harm us as an auditor to take on a company that. So if the auditor accepts a client with high engagement risk, the auditor has to conduct a more rigorous audit, and the auditor does this by setting audit risk at a very low level. We're not going to tolerate much deviation. If the auditor accepts a client with low engagement risk, then the auditor can handle a higher audit risk level because we really feel safe with the controls in place. Therefore, we don't have to scrutinize every account to the degree we're worried about. Okay? Any questions?